Thank you very much. I'm delighted to be here. I'm a professor, but unlike the philosophers and professors who are interested in very abstract ideas, I'm a practical economist, and you are people who are dealing with the markets, so it is my pleasure to be here and to present to you not only facts, but one way of thinking. I've been asked to talk about monetary policy, which is a wonderful topic, and in particular its impact in terms of interest rates, and to clarify essentially what it is that I would like to do is talk about interest rates with particularly the short term and the long term, the Fed funds and the 10-year note. And I'm smart enough to know that things constantly change on the basis of data. So I'm not standing here boldly to make a forecast for the next 5 years. I know it will be absolutely wrong. So I'm modest, and what I want to present to you is the short term, the next 6 months, which, by the way, will be very, very exciting months in view of the transition from the Bernanke to the Yellen Fed. And I do not anticipate any major shifts, but it is an occasion that doesn't happen very, very often. When we talk about the forecast, I want to make clear to you what are the variables in my head. And those variables are the economy. And when we talk about the economy, GDP, unemployment, and inflation, you may say, well, you're not saying anything about the debt. You're not saying anything about the government. There are certain things that are important, and we can express certain ideas, but there are other things that if we try to introduce too many variables all at once, we somehow lose what the main trends may be. So in addition to the economy, I would like to also talk about the Federal Reserve, because the Federal Reserve, as you know, has evolved to be an extremely influential institution. It wasn't all that much 20 years ago, but it's now essentially becoming almost the exclusive agency or player that is trying to guide the economy. And of course, these two factors are very, very important, but all of these are reflexive in terms of expectations by investors. And I also know that no matter how much a person reflects and carefully considers ways, there are unexpected tail events, and those events we cannot predict. So if certain events were to happen, such as a big hurricane, well, obviously that's something that we could not really address. In terms of GDP, you can see that in the past we had a great deal of variability. When it comes to forecasting, very few people are bold to say that one quarter will grow by 2%, 1.3 down to 1. So we tend to more or less average things out. So the best minds today, on the basis of the current information that is available, we are forecasting a growth of approximately 2.5% real growth. You may consider that to be a little pessimistic, but somehow the recent data, the last 5 years, do not allow us, statistically, mathematically, to crank up numbers that are much bigger than that. Interesting also to see that when we talk about GDP, and as you look at the economy in its totality, the myriad things that happen on a daily basis. And you have them all to the right, the Lehman bankruptcy, the Q1 and the Q2, the Q3 announcements, somehow do not influence GDP. GDP is this incredible big elephant that keeps on going and doesn't pay attention to whether it's rain, it's hot, the ground is shaking, there are carrots or there are sugar canes. It keeps on going. And we are currently below our potential And you constantly hear that for the last 5 years, the foregone GDP that we could have produced and we did not produce is getting very close to $10 trillion, and it keeps on adding. And you can see how this has been spread around the economy, and it is continued. No one at this point, the Fed or the private sector, has come up with a beautiful forecast to say at the very end it starts a sharp going up trend. We keep going at low rates. And Barron's had recently an article which essentially says, well, if we were to look at not only the recent 5 years, but really the trend going all the way back to 50s, it seems that GDP seems to be constrained by several factors, and the trend is toward modest growth. Why? And then we can take the components. Consumption is not doing all that good, is not doing all that bad either, approximately around 2.5%. Consumers are still deleveraging. This is the path compared to in the past 4%, around 2%. Interestingly enough, look at the late 60s and the Reagan years. Government in the past was contributing approximately 1 to 2% of GDP. The last 5 years, with all its difficulties, it's not only not contributing, but it is acting as a drag. And you of course know that one of the reasons is the fact that our debt seems to be getting bigger and bigger. There is no growth, revenue is not big, and therefore the expenditure is not there. The population is slightly declining. Median households stay where they are. We saw the red line GDP not growing all that fast, and of course consumption. But the most interesting thing for the private sector is the fact that investment is not responding. And investment has been very, very low, which is the last one. So in conclusion, as we look into the future, particularly as we want to make forecasts about interest rates, we at least see that factors that usually push interest rates to increase as a result of robust growth, consumption, investments, government expenditures and government expanding, at least those winds are not there. Those trends are not there to cause interest rates to really keep galloping higher and higher. This does not mean that investors may not get excited and try to push the T-note bill as they did the last couple of months sufficiently high, maybe 100 basis points. But the trend for this to be sustainable are not there, at least on the basis of the best intelligence and wisdom that we have, not on one factor, but on many factors, all the way from consumption, investment, long trend, labor dynamics, and the role of the government. The good news is we're doing better than the rest of the world. And you can see that countries like the Eurozone, Japan, UK are having significantly more difficulties, primarily because they're a little smaller. I don't want to move to emerging markets and China. The situation there is not all that different in terms of their trends because they rely on exports, and these countries are not there to move them. All right. So we finished with the big component, GDP. We come now to inflation. It would be difficult to argue that in the environment that I described, inflation is going to take off. And indeed, what you see here is the long trend in terms of inflation, and an interesting and disturbing point which we cannot really exclude as we move forward is that United States, for the first time during this recession, we had actually deflation. And we have forgotten about this discussion which goes back to 2009 and how nervous the Federal Reserve was in terms of deflation. The lesson in terms of inflation is any number above 2%, 2.5% is very bad because it creates a great deal of uncertainty moving forward. It causes interest rates, which we know are the result of real factors, productivity, and an inflation premium to go high. So we don't want inflation. We learn it from history. Inflation above 3% is a disaster. My grandmother in Greece repeatedly told me the following story. In 1938, she and her husband gave a debt, a loan, to her brother, and with the money that they gave him, he bought 2 top quality cows for his farm, small farm. 5 years later, the money that he returned, my grandmother bought 2 eggs. That's the rate of inflation in Greece in the 40s. Why? Because the Germans came in. The occupation forces of the German army were not financed from Berlin. Every country that they occupied, they imposed a huge tax. They received the cost of running that army, and the central bank printed paper. And Greece had inflation something like 3,000% per year over a period of about 5 years. This is why when you hear Greece complaining and saying, Germans, don't be tough on us, you owe us money, we do not owe you, it goes back to the hyperinflation in the 40s when the Germans occupied Greece. So inflation above 3% is very bad. But it is worse when inflation becomes deflation, because deflation means everyone is postponing making an investment because tomorrow's prices will be lower than today's. You don't buy a house, it goes down. You don't buy a car, it is. You postpone getting your MBA because Loyola may reduce its fees. So deflation is a bad outcome. And we have a very small window as far as inflation is concerned, 0 to 2.5%. As a matter of fact, as you look forward all the way to 2022, the best models we have from the Federal Reserve and other places do not predict anywhere inflation above 2.5%. So in case that you see it for today, and you say, nobody knows tomorrow, again, on the basis of past data and the best techniques that we have in terms of making projections, inflation. If this is the outlook for inflation, how could interest rates go up to 10%? Unlikely. If the central bank here in the United States, the Fed, like the European Central Bank, had only one goal, to watch inflation, we would not really have any problem, simply because the path of prices has been significantly below the 2% goal. And this is one reason why the European Central Bank recently dropped interest rates, because they are experiencing low inflation, 1 to 2%, and they want to go out of their way to move the economy to get out of it. So as far as the economy is moving slowly, inflation is not a problem. Well, there is a problem, unlike inflation, and this is unemployment. And unemployment currently is 7.3. We do get very excited like everybody did, and the markets reacted wonderfully when the news comes out. But you need to rely on at least the 6-month moving average, because this data is extremely noisy. And you cannot really get any big trend, indication, signal out of any specific period. And as long as unemployment is very high and inflation is very low, the Federal Reserve then is free to follow an easy monetary policy. As far as unemployment is concerned, again, the best models, some models that interpret expectations, interest rates, monetary policy, all of them give us, this is kind of depressing and discouraging, that it may take several years for unemployment to correct. And this is another different forecast. And when it comes then to the Federal Reserve, the way to see it is that if we take 2% goal of inflation and 5.5% goal for unemployment, and if this is the target where the economy should be, we've been moving, correct, from unemployment 10% and inflation over here. So we are moving very, very slowly close to the target. And as long as the inflation does not get in this region, namely above 2%, keeping unemployment as a target appears to be legitimate. These are the expectations by investors, and in view of all the things that I said, if you use the VIX and some other measures, compared to the very past, we are in an extremely nervous period. So as you make the forecast, certain things seem to be steady, inflation, unemployment, GDP, but all of us on a daily basis are watching all of these and responding in such a way that we express our nervousness. So, in terms of the Fed then, what has the Fed tried to do? The two tools that it used, the 3 rounds of quantitative easing, and remember, there was one, and we said there won't be a second one, and we kept on guessing, and 2, there won't be a third one. And continuous effort, particularly in terms of communication and forward guidance. One interesting thing that may happen as a result of Yellen coming in, you may recall that Greenspan controlled very well all the members of the Open Markets Committee, did not allow them to just go around saying anything that they believed. He always spoke first in all the meetings and says, I believe thus and thus and thus and thus. Bernanke, as an academician, reversed the whole situation and says, let the market realize all our agonies and deliberations, go out and talk. He's always the last one to talk. We're finding out that there is a little bit of confusion. We're tapering, we're not tapering. This week, too, Dallas and St. Louis, maybe Kansas, are saying, well, there should be tapering immediately in December. You hear it and you say, well, maybe they'll do it, maybe they will not do it. Yellen will try to bring back a little bit of a discipline. We've gone from one extreme, don't say much, the other extreme, feel free to say what you think. A little bit of a coordination. That's one small prediction. I personally enjoy hearing all those ideas, but I don't think the market like it because it creates a great deal of uncertainty. People make money, lose money, they do not know exactly what may be happening. And we saw here the long history, and in particular, we see over here the changes with Bernanke, because there was an indication in June that Bernanke says, well, we may be reaching the point. It seems to me, and some of you may know the details, that this quantitative easing 3 has lasted longer than the other ones and have been more substantial. The first one was 600, the second one 600. This one is a year and a half at about 80, close to $1 trillion. And we're not anywhere close to finishing it. So the markets are saying the termination of that process is a little overdue, and what are we going to do in terms of responding to it? And you see here mortgages and 10-year notes with essentially an approximately 200 basis point between the T-notes and the conventional mortgage, which causes a great deal of difficulty, because any time that they're talking about eliminating or completing or stopping and the T-notes take off, immediately the housing activity almost comes to a standstill. So there is a difficulty in that direction. How good has quantitative easing been? Well, it's a big controversy, hundreds of papers. I'll show you a table. It's not, people, here is not working, here it is working, here it is working, and the only thing that is very, very clear is the profound accumulation of all this bonds and mortgage-backed securities that have been accumulated in the balance sheet of the Fed. This is putting things in perspective in the very, very long run in terms of what was happening and what's happening recently. Here you see that all the other corporate bonds follow the government paper in different varieties, so there is some consistency. And here is a table. You don't have to memorize it. I do not know it myself. But John Williams from the San Francisco Fed gave recently a beautiful discussion, a very nice paper in October, summarizes all studies going all the way back in early 60s. And essentially, the points, the results are as follows. The best one can say, given that those studies are done very, very professional, very systematically, is that quantitative easing 2 probably reduced the 10-year note by 20 basis points. 3 was a little more effective because it came after the first one. And interestingly enough, the T-notes have responded by taking back the reduction of 40 to 50 basis. Maybe they overshot a little bit, around 60, 70, 80 basis points. In general, we know that the 1% reduction by a whole point, Feds, the 10-year notes respond much, much less. Equity markets did very well. Unemployment has been reduced. If Milton Friedman were to walk in, he would say unemployment is not affected by interest rates. Unemployment is affected by the fundamentals of the economy, and interest rate is one among many, many variables. But the growth of incomes, the productivity, the only thing that Milton Friedman wanted monetary policy to do is not to disturb the private sector rather than try to create and generate economic activity. Here, when we look at the data and we look at the numbers, we simply say there appears to be a relationship, but we are not talking in terms of an exact mathematical engineering causality between quantitative easing and unemployment. So as we move forward today, given this background of all this discussion, the issue is not Fed funds. The issue is quantitative easing. Fed funds most likely will be, I will argue that they will stay where they are at 25 basis points, probably to the end of 2014. But when it comes to quantitative easing, what are the choices, and as a result of that, what are the implications in terms of interest rates? Well, obviously one choice is we continue with the current program, 85 million month after month, half in treasuries and half in mortgage-backed securities. Bernanke is not going to do it the last couple of meetings that he's chair. Yellen probably would like to have the choice to put her own team and make certain decisions. But at the same time, there is sufficient independence in the open market committee and in the voting partner that some people say, we're an institution and our job is to help the markets and protect the economy, and who is in what position doesn't make any difference. We need to send a signal that that program that has been there for a long time has come to start modifying it or reducing it. So there's a probability of a small symbolic signaling. Even what I'm writing over there is not really something that I dreamed. People already are talking about it. And there is a much larger one, but for the larger, let's say half the size, would have to be driven data. We have to receive incredible data that unemployment is going down very, very radically, or inflation is increasing. Something inflation instead of 1.5, jumping a little higher. Unemployment is in a right trend, and if we accept the fact that it has become a target that as long as inflation is below 2%, the goal is to reach unemployment down to 6.5%. We are currently at 7.3%. We have at least a year. Because, around October 14, this is when we anticipate that we may be reaching if no big disturbances are there. This is the guidance. At this point, they keep saying we're down and will remain and will continue remaining. And in terms of expectations, in terms of futures Fed funds, there is no changes until mid 2014, if not 15. And here we can see it a little better. The curves keep shifting on the basis of anticipations month to month. These are various contracts. And you see from October 14 to 15, the next 2 years, Fed funds at most could be up to 50 basis points, which is currently at 25. This is what we are expecting. Not incredible changes in the future in terms of Fed funds. You may say, well, when will they return to the average usual 4 to 5%? 2022. And in markets where you expect things to happen in a day, in a month, in a year, I mean, this is 10 years, correct, to return back to normal. Again, all of these are statistical calculations, the best engineering, the best mathematical, the best statistical, given the recent history. Here is a very long graph of how close real and Taylor rule formulas work together. And the interesting thing is that when we had the crisis, the Taylor rule, because unemployment went very high to 10%, there was no inflation, it kept signaling that interest rates short-term should be negative. The Federal Reserve does not have the choice of negative interest rates. The worst it can be is down to zero. What does it mean to say interest rates are negative? And they continue to be negative. Interest negative means the following. The economy is so weak, and unemployment is so high, and inflation is absolutely no threat, that the Federal Reserve tells the banks, and the banks tell the public, you can borrow 100 from us today. Next year, you return 97. It would have taken such a radical approach mechanically, mathematically, correct? A formula. Here's a formula that fits all the Fed funds when they were positive, when unemployment was 4.5%, when inflation was 2%. There is such a vast number of unemployed that, you know what, Malliaris, you want to borrow $100,000 to buy a house? We'll lend you $100,000. Next year, we'll readjust your mortgage. You pay $297, zero interest. And the following year, we readjust it, another 3% lower, and people then would go out and buy to bring back unemployment to where it was. But there is a zero bound. We are not working with negative interest rates. We don't know how to do that. Therefore then, reducing the unemployed takes a very long time. And this is why those models predict such a long period of adjustments. My assistant here, we redid the same graph during the years where interest rates were positive by fitting deviations from inflation, deviations from unemployment. So there is a reasonably good fit, what interest rates ought to have been, what they were. Here you see that somehow Greenspan kept Fed funds a little lower than they ought to have been, possibly causing the housing bubble. But according to my estimations, we had reached the point where interest rates went by 2014 toward the end, 7th, 8th, 9th, by October, you expect ultimately the economy to have caught up with this long 5-year where we could not implement negative interest rates. Therefore, we were stuck with zero Fed funds and in its place used quantitative easing. Here is the yield curve and how it constantly moves. It shows signs of hope that moving forward, this could be, given that inflation is very small, a sign of, it moves. It goes from here, it went up, it readjusted, and we are at the point here where there is constant fluctuations in terms of moving forward. This is the 10-year note that most of you know, and I'm sure you trade. Big move recently, but in terms of its historical averages, when quantitative easing 3 had not really taken place, it's still a little below. And in terms of summary then, very probable nothing happens in terms of Fed funds between now and June. If I were to be a speculative professor, I would say push it a little further, maybe October, November, December. So for a year. Quantitative easing remains in place until the Yellen Fed takes charge. There is a little bit of fluctuation because it will be between now and then. We're talking about 4 months with 4 additional pieces of information in terms of unemployment. Good things happening, bad things happening, housing going up, we get excited. Housing is not doing very well. Consumption, oil is down, but other materials are going up. A big reduction, very unlikely. And the final issue then, if I do not see big changes in terms of quantitative easing, at what point does it end? Remember, quantitative easing 1, quantitative easing 2, always when announced had an end. It says for the next 12 months we are going to do 600 billion. The markets knew. This one is open-ended, and it's the biggest. Some people, the Minneapolis Fed person says 6.5% of Evans here in Chicago is too high. We want it to continue until 5.5. Well, 5.5 is a couple more years. Therefore, this current excitement in terms of T-notes rates going up and then those plunging is unwarranted. Maybe there will be a correction. We got excited, they went up, interest rates up, they're going down. Since inflation is not expected, I showed you all those graphs for the next 10 years, and unemployment is moving down very, very slowly, it could be that quantitative easing is not really terminated anytime soon. But my simplistic mind tells me that when Yellen comes, she will give forward guidance and say, this quantitative easing has been around for a long time. We hope to continue it up until X in June, September. At this point, we'll take a breather and evaluate the situation. And on the basis of what the economy tells us, we'll decide what will happen next. If this is a reasonable approach, I want then to ask the final question: what is the probability for a quantitative easing number 4? Are we done or not? And you, as you look at the markets and as you take positions, should you be flexible and open to good news? Unemployment is down to 5.5%. Fed funds start going up a little bit slowly over a period of 2 years, 3 years. So by 2014, 15, 16, 17, 18, we're back to 5. What could possibly happen? Here we have a little bit the history of Japan. And the history of Japan essentially tells you that when you have a really bad financial crisis, there are 2 ways to respond. One is to allow somehow the economy very, very quickly to go down, and you resist the temptation to stimulate the economy while it is weak. And after the excesses are removed, washed away, washed out, the economy recovers very, very quickly. The temptation, of course, is for governments, and in particular for central banks, to move in very quickly to avoid the economies from really collapsing to the point that would naturally reach if there was no intervention. So we were talking a little earlier, we're talking about a V shape or a U shape. Remember how those recessions and the discussions were, do we go sharply down and sharply up, or do we prolong it? What we have found out, given that we're following the red line, is that when there are certain bubbles that collapse and we push the economy a little higher, it is very difficult to remove the economy from a continuous process of quantitative easing. Because, let's briefly, and this is at the end, we can discuss anything you wish, but as we are moving slowly, watch what happens in terms of quantitative easing 1, 2, and 3. The economy is not moving. The Federal Reserve comes and says, we are going to push long-term interest rates because there is very little we can do with short-term interest rates, and there is very little we can do with negative interest rates. So here is 600 billion, and the markets get happy, and interest rates drop a little bit, but the drop in those interest rates is not sufficiently large to move us outside. So we grow a little bit, and then they say, okay, let's take 6 months and decide what is happening, and the economy becomes very, very weak again, and there is a second round. So one thing that academics and practitioners and central bankers from Japan are telling us is quantitative easing is a method that is useful, but it is a very difficult method to remove once you start it. Because even right now in this most recent one, Bernanke was ready to stop quantitative easing number 3 in June. And the fact that he just mentioned it, long-term interest rates, 10-year notes, jumped up, and mortgage rates from 3 went up to 5. And within a month, Wall Street journalists are talking about, says, housing activity is suffering, mortgage rates at 5%. So he sits over there and he says, wait a minute, we've spent 5 years trying to bring this economy out of its recession. We are making very slow progress. Do I want at this point to ruin the little progress we made? We'll continue quantitative easing. So the last idea then I want to leave with you is not only we are moving slowly, and thank God we're moving slowly. It could be much worse like in Europe or other countries like Japan. But because we're moving slowly and because the private sector has not recovered well, and notice I have not said a word about the global economy or the politics, the Obama administration, and what is happening to our system and the economy and the confusion that exists, correct? This is, I'm talking about things that we know, understand, and we can logically discuss about. We're not here to philosophize, what ought to be done or not to be done. But within that context, quantitative easing will end, maybe a little later rather than sooner, but the fact that it will end does not mean that the process of helping the economy will come to an end. Therefore, what I would encourage you to continue watching continuously is as unemployment is moving toward 6.5, eventually 5.5, I worry about the possibility of deflation. And deflation so far at 1.5% is not such a big possibility. But deflation without all the stimulus may have been a reality. So ultimately what quantitative easing has done is not so much to recover us quickly, but to avoid the US economy from moving into deflation and therefore experiencing what Japan has experienced over a period of 10 years. And deflation is an issue to watch, and the fact that gold has been doing for a year now. I mean, Soros was one of the first ones about a year ago in December to say, selling everything. There is an anticipation that the economies of the world will move very, very slowly, and gold does not give good returns in such environments. So watching unemployment is important, but paying attention to inflation, in my judgment, is much more important. And if inflation becomes negative, interest rates, all interest rates, we're here worrying, is the 10-year note moved from 2.7 to 3.5? Is it going to go to 4 or 5? What if the yield curve shifts backwards, shifts downwards, and as a result of deflation? So that's a concern that is worth watching. And I do not know exactly. I hope that there's quantitative easing to avoid falling in the trap of deflation. So, thank you for your patience. I think the discussions should be much more interesting, but these are my thoughts. Any questions on practically anything you wish, including what's the best Greek restaurant? Yes?
Is there a good advantage like the U.S. has being in a position of power and like basically saying that, you know, we're going to loan money for 30 years, and some people say that the government understates inflation and whatnot, and that the real inflation rate is whatever, 4 or 5%, something in that range. And somehow people were willing to loan us money. I mean, I know the Fed is trying to keep the interest rate down on the long end, but what is it, like that's like what needs to go into the model is what gives us that ability to loan. Like that's all the Fed wants, right? Because we're in so much debt, and that as long as we can continue to loan money at negative interest rates, we just keep blowing up government.
Yes, the way the way I will rephrase, I agree with what you said, is that the Federal Reserve cannot create jobs. The Federal Reserve cannot get up tomorrow and say inflation is 3%. The Federal Reserve can buy us time, and it is up to the business sector, the financial sector, the political sector, to put our house in order. This needs to be done. I mean, we have examples of Greece. I was at the Treasury and I left at the age of 27 because I saw, for instance, what was happening in Greece. To give an example, we had year after year deficits. And then we made a projection. And I was part of a team that looked at the numbers and did a simple regression. And we said, next year, the deficit will drop from 75% of GDP down to 60. The politicians got it. This is wonderful. The year comes by, instead of going to 65, was 85%. No one responded. We make another projection, it's going to go to 70. Wishful thinking. It comes out that it was 95. No one said anything. Up until it went all the way to 160, and people said, we want our money. And we said, we don't have anything to give you. So I do not know how to respond because I don't understand. We live together. Please help me. Why is it that people ignore repeated signals that things are not in order?
Yeah, I mean, I think it has to do with the military that we have that should get into models. That basically makes it so, you know, it's like an economic game of like cat and mouse where right now, don't you think it's sort of like an act of war? If you just say we're never going to taper ever and all the debt in the whole world is, you know, we're not going to pay you.
Well, you see, the problem is, okay, one thought as an example. The same way you understand the logic that Greece expands the debt, wishes to reduce it, it expands it further, wishes to reduce it, expands it further. We are in that process. How long do you think that people will be able to accept the fact that the Federal Reserve, from 1 trillion, it took the Federal Reserve essentially 95 years from earnings, from processing your checks. Now they don't have that earnings. The only earnings the Federal Reserve has today is the interest on the bonds that it collects. So it collects all those bonds, and we say it has 3 trillion bonds and mortgage-backed securities. Let's say they yield on average 3%. So this money comes to the Fed. In the past, it used to be that they process checks. So it takes the Fed as an institution, as a firm, 100 years to accumulate 1 trillion capital. And now they expand to 3. They have approximately 10% of mortgage-backed securities plus government bonds. Government debt is 15 trillion, mortgage-backed securities 8, 9, 10 trillion. They have 3.5, approximately 10%. You guys are traders. I read in Wall Street Journal, please confirm it, I want to hear it. 50% of the daily volume, a market maker on a daily volume, the Federal Reserve desk is 50% of the volume. In some cases as high as 90, some cases as low as 30.
Do you think that's why this is doing?
This is huge. It used to be no more than 3% open market operations, the stuff they taught you in school. Remember, open market operations was 3% on a daily basis. So the question is, all of us here in this room, we're very reasonable people. We are not the ones who don't have any information, because lots of people have no clue what the Fed does and they think they're printing paper. It's all electronic. But how big should the budget of the Fed become before you and I are concerned? Because why? If they collect from 3 trillion to 6, 7, 8, the question then comes up, how do they unload it? And if they unload it, what will happen to interest rates? I mean, it could be that what they say at the Fed, and they are very good now. 5 years ago, at the Federal Reserve, they did not have any long-term, good, smart traders. They had people like me, thinkers. Well, I may know certain things, but I cannot trade, buy and sell at good prices. I don't know whom to call to make markets. So they have all these people and they say, well, we are now ready. You see, with low long-term interest rates, all the insurance companies which hold long-term notes and treasuries, they have recapitalized their positions and they bought these positions. And corporations, all the short-term deleverages has become long. But the Fed, to preserve its credibility, cannot keep on accumulating debt, because logically at some point some people say it's not credible.
Like 3 trillion? 5 trillion?
Bravo. No, you're exactly right, because we fall in that trap also without public debt. 70% okay, 75, 60. 80, 90, and then the Harvard people come and they say at 95 there is a critical point. Well, you don't want it to go there, because debt, particularly when it becomes very high, it stalls growth. Correct? Lots of interest goes to pay the debt. You cannot spend more to grow. See what's happening to the government. The government now is not contributing to our growth. It's applying brakes. You see it 1 year, say it's not real, it's temporary. Well, but now we have 5 years. There is a trend, correct? 5 years times 12 months, there's lots of data. Yes?
Should debt to GDP be a third mandate?
There is an advantage, disadvantage. If we are totally undisciplined, obviously a rule will help it, because we don't seem to be willing to do it. If you put a rule, sometimes those rules are incredibly binding. There is a difficult situation, you want to go above, you want to go below. So the ideal is logical, responsible people knowing that there is an ideal 70%, give and take 15%. I mean, history proves this is a good number, but then follow it. Somehow now, because of the current situation, as difficult as it is, with a large section of the people not doing well, politically there is polarization. And when there is such polarization, it's difficult to make progress. I mean, it's happening here, it's happening in Europe. I mean, look at Italy, look at Spain, look at Greece. There is an issue. And that is always a big burden for the new generation. And unfortunately, I do my duty, people here. I go to my class, 2/3 undergraduates in economics and business, 1/3 political science, philosophy. They say we need more spending. I said, are you aware it's coming from you? They say, no, it's from the rich today. I said, I'll be happy to pay for 2-3 years. You'll pay for 60 years. They say, really? So they need to understand that the debt is a long-term burden. And if you know and you want to do it, that's wonderful. But what we try to do is try to be generous when we are not willing to contribute. Yes?
I would like to get your thoughts on, you spoke at the end about the concern being potential deflation. I think personally that there's even a greater chance of deflation in Europe, and I wanted to get your thoughts on the ECB. And do you think they will ever move to a major quantitative easing policy similar to the Fed? Would the Germans allow that? Would the Eurozone break up before they went to a massive money printing operation like that?
All of these concerns are very real, and on a day-to-day basis, every morning that you get up and there's no big crisis, one needs to be very, very thankful, because up until now, the only thing we experienced was the difficulty of Greece, which is 2% of GDP and not terribly significant. And Greece responded remarkably well. To give you an example, my younger brother, who came to the United States, got a degree in marketing, and decided to go back. He's now full professor in a very good university. He says, all professors and teachers, all the military, all the judges and the judicial system, and all the military, something like 2.3 million people out of a labor force of 4.5, 40% of it, experienced a 40% cut, not tax, 40% cut in their salaries. So my brother was making, as a professor, salaries are very low, 60,000, and he's currently making 36. All of them. People anticipated major strikes, difficulties, problem. Out of, in his university, 700 faculty, 7 resigned. He says, 7 were very bold. They said, this is unacceptable. The left went to England and Australia. And I have one friend came back to the United States. Now, take that 40% to Italy, or to Spain, or to France. So, Germany, at some point, will not have the stamina, the control, the power, the political bargaining to impose because they are doing very well. It says in Germany, we believe in discipline. I said, is it discipline? He says, Professor, you're smart. It is fear. We fire people. We punish people. Now, try to do that in Italy. So the health system, perfectly well, they say, Professor, you're in charge of this area with another 30 specialists, whatever the team is. Here's your budget. Here's the people. If you run out, don't do the operations. If you want to do it, we cut your salary. Draconian measures. The rest are not going to do it. So at some point then, the European Central Bank will do drastic steps, because letting the euro go, it will be a massive a disaster to the global markets because the dollar is not doing good. China is not ready to assume the leadership. Japan is weak. We've had a problem with global imbalances between China and the United States for a very long time. I mean, it could be a massive disruption. So we are at the verge of needing to do a lot. And unfortunately, it's only the central banks because and today I was reading Mohamed El-Arian from PIMCO, it's made the statement. As you know, we're celebrating 100 years of the Federal Reserve this year, 2013. El-Arian says, if the central banks assume much bigger responsibilities that they can, it is desirable. They lose their independence. They do not perform as well. And it's interesting, I mean, it doesn't take much to anticipate that when Yellen on Thursday goes for the hearings, it will be over and over and over unemployment. You haven't done anything. You take care of the Morgan Stanleys and the JP Morgans and AIG and the poor people and on and on and on. It is a dual mandate, inflation and unemployment. But at the same time, what is it that they can do? I mean, interest rates are down to zero. I mean, if I were her, I'd say, sir, madam, we brought interest rates down to zero. There's nothing else we can do. Are you? Well, if they get mad at her, they don't nominate, they don't approve. Yeah. Yeah.
The reason the politicians aren't acting is because the stock market is at all-time highs, rates are super low, there's no pain.
But this increase, as welcome as it is, and legitimate by capital asset pricing, because if the risk-free is equal to zero, plus a risk premium plus market, 7, 8, 9, 10%. I mean, 30% increases, it's a little bit a sign of desperation. People are moving their money from bonds that may collapse and this and that, they're putting it there. But that's fragile.
Right.
Very fragile. And it's better to have one sector that is doing good, and it's not overpriced by all measures, but if it continues, it is a concern. So to go back to your question, Europe is for the first time in very difficult, I mean, they're running out of options. And Germany will continue exercising its influence, but the euro is doing poorly. So at some point, they have not been successful in getting France, Spain, and Italy to put their houses in order. Greece, close, not a lot, but Greece has 25% unemployment. I mean, my brother, again, to give you flesh and blood situation, he has a son and a daughter, 24, 22. He says, the only thing I can do for my children with degrees in accounting and degrees in finance is open for my daughter a small boutique, 50,000 euros, and let her sell clothing. And for my son, a pizza place. There's nothing else. No jobs. To get an office job. It's not developed. So they're all with their families. Italy, the same way. 40% unemployment for young people. I mean, in a graduating class of 200 in accounting, 5 find jobs with their families, friends, and others. Well, Greece is absorbing it, but Italy cannot absorb it. So, and who's there to help us? China is still very young, I mean, in terms of economic situation. So we are the leaders. I mean, I view our role at this point, and if United States does several things that are inspiring, the whole world would be very enthusiastic. And maybe we can help more Europe by doing the right thing here than the rhetoric of you guys do this and this and this.
Professor, I want to cut off our
Sure.
program here and thank you again very much. This was really great.
All right, thank you. Wonderful.
From Advantage Futures, again, we really appreciate you.
Pleasure. Thank you. Thank you.
And if you guys have questions while we're wrapping up, feel free to come
Yes.
talk to the
Yeah,
professor.
I'm.
And we're going to be continuing our economic theme, and we'll have the chief economist from CME, Blue Putnam, will be speaking
Oh,
here in early
no blue.
January
That's
as well.
wonderful.
So